last couple weeks. And I can tell you that I've been really comforted by this resounding feel of optimism and hope. And I think that may be because not that we're necessarily hitting reset, but that we maybe are all slowing down, focusing on things that we may have otherwise not been able to focus on because we were just simply too busy. Maybe that's spending time with our family. I know I've certainly enjoyed spending more time with mine. Maybe that's some personal development that we're able to do. Maybe, and the reason you're on this call today is how you plan and think differently for your financial future. How do you spend? How do you save? How do you build wealth? So to that end, I'm excited to share what I believe are some very impactful strategies to help insulate yourself from a variety of uncontrollable factors. Our objective at Prevail, our overall objective, is to help put individuals and families in more financial control, eliminate the what ifs, and really place peace of mind over uncertainty. A lot of these strategies that you're going to view today, we're actually watching work and be effective in real time. And that's rewarding. Now, I don't know what I'm going to share with you today is going to fit your situation. Is it going to be right for you? What I absolutely know is that it's worth learning about, worth understanding, and worth exploring. I'm not a CPA. I'm not an attorney. I don't pretend to be one. I do work with a lot of legal and tax professionals. Prevail has a wonderful, robust team of professionals. I myself have been advising on these types of strategies for nearly 20 years. I also have to caution you that, like you, I am working from home, and I cannot guarantee that a 3-year-old followed by a 10-year-old is not going to come running through that door, or that you're not going to hear some animation in the background. But with that, let's go ahead and get started. And I want to introduce you to a client of mine, the Bell family, Ryan, Tiffany, Wilson, and Samantha. They look happy. They're a wonderful family. No, these are not their real pictures. And yes, I did change their names, but situationally, these are my clients. And while their situation won't be identical to yours, I believe that there are aspects to their situation that will be applicable. And because of that, I wanted to share their story. I wanted to share their experience of this strategy through the lens of their eyes, because I believe that it will better frame it for you. Ryan is 43, has a great job, VP of Sales. Tiffany is a human resource executive. Wilson is an avid and great soccer player. And I'm convinced that Samantha, in about 15 to 20 years, is going to be on Dancing with the Stars and likely a winner. Now, the Bell family, like many of the clients that we work for, are good stewards of their money. They are very concerned about their financial future. They are great savers. They are saving for college. They're actually contributing the max to their 401k. They're doing a variety of other investments. We're in the process of talking about real estate and some other things. But the question that I asked them in the very beginning, and it's a question that I want to ask all of you, what is wealth? How do you define that? And that may not be an easy answer to come up with. And I think that primarily is because our society seems to impose this certain view of wealth. And it's really not a predefined number defined by somebody else. It's personal. It's up to you. And I'd like to suggest that it really is whatever amount that you consider enough to free you financially to do the things that you want to do and not have to do. Accumulating and preserving that wealth should be the focus of financial planning. And it's certainly the focus at what we do at Prevail. Now, we're also privileged to be able to work with a significant amount of financial advisors across the country. And those financial advisors all have their own firm, their own shop. They use Prevail and us as primarily a subject matter expert. But what we've come to find out in looking at how they view financial planning is that most of these planners out there are really focused on the accumulation phase. And while that's obviously important, I would argue that it's really the distribution phase that's more important. So while accumulation can certainly be the focus, it's with distribution in mind, both for retirement as well as our inheritance. What are we looking to leave as a legacy to others? We've also identified 4 primary headwinds that can impede not only the accumulation, but the preservation of wealth. One of which is what we're facing right now. That's market volatility. And while the industry experts will certainly speak to the fact that over the long haul, you can ride the ups and ride the downs, and a well-balanced portfolio is going to increase in value, that is certainly true. But for those of us, or those of you that might be in the distribution phase, when the market is down by 20 and 30% and you're relying on those assets to live off of, that can certainly create an uneasy and almost fearful situation. How do you insulate against that? Healthcare costs. I was reading a statistic not too long ago, and it was a little bit disturbing. It said that 69% of those turning 65 this year are going to need some form of long-term care. And of those, 15%, the cost of that care is going to be over $250,000. Now, unfortunately, I can tell you from experience that I have watched families who have accumulated wealth, watch it be significantly diluted in the last 2 to 3 years of their life. How do you protect against that? Litigation. Now, while certainly not as visible as the first two, for some individuals and for some families, this is a real threat, particularly with our litigious society. How do you insulate dollars from that? And lastly, taxes. Now, I don't put taxes lastly in form of priority. In fact, it's quite the contrary. I put taxes last because it's probably the least focused item that we look at as far as impeding accumulation and preservation of wealth, that can have actually the most significant impact with just minor changes to the net result. All of these, to some degree or another, can drive down wealth. One or more of these you will experience either whether you're in the accumulation or the distribution phase. Maybe it's just market volatility, but I'm going to also suggest that you might be concerned with taxes. And as a result, taxes, and of course aptly named Tax-Free Wealth as a seminar, is going to be the focus, or the primary focus, of this discussion moving forward. And primarily it's because taxes are unknown. If I were to ask all of you what your tax rate is going to be in 15, 20, 30, 40 years from now, more than likely you can't tell me the answer. In fact, if you can, you probably got a crystal ball and we should talk afterwards. So it's an unknown number, and we actually believe that tax rates are going to be higher in the future. What are your options to insulate yourself from that? What are your options to put yourself in more control over that particular factor? Because if taxes are higher, if we are correct in the future, and I'm going to walk you through why we believe this, but if we're correct, what will your nest egg look like? Will it be as large or as stable as you had hoped? Now, to answer this question, we really need to first look at the cause. We need to first look at the roots. We need to understand the U.S. financials. Can anybody tell me, and we'll try to make this interactive when I do this in front of a live audience, obviously it's a little bit easier, but if you're with somebody or even just yourself, shout out the answer to yourself and see if your guess is right. But does anybody know what our national debt is as of today? It's $24 trillion. Now, for many of us, this may be just a number. It's almost monopoly money. But I can tell you that it is very, very real. In fact, if you're looking for a fun activity, I did this with my 10-year-old. Google, what does $24 trillion look like? And I think it will put into perspective just how large this number is. This also doesn't include the unfunded liabilities in Medicare and Social Security, the promises that we have to keep. And if you were to take that into account, the debt is actually over $100 trillion. This also doesn't include the recent CARES Act, the stimulus bill, $2 trillion that is being pushed out. And some experts are even saying that amount could reach $6 trillion based on all the reserve requirements. So we've added 10 to 30% in the last few weeks to our overall budget or debt. How does the government pay for all that? Well, they do it, of course, through revenues, through taxes. Does anybody know what the current top marginal tax rate is? The rate at which Bill Gates pays the majority of his earned income in today's environment. If you guess 37%, you are correct. What is the low top marginal tax rate in U.S. history? The lowest met rate. It's 7% back in 1913. Boy, did that look nice. Now, what's the highest? This might be a little disturbing. It was 94% back in 1944. 94 cents of every dollar over 200,000, which I recognize as a large number, but 94 cents didn't even include state tax, went to the federal government. Where will taxes be in the future? Because there's lots of room for changes. To show this to you a little bit differently, I put it onto a graph, and you can see there's the 7% on the far left. You have the 94%, which is the large top graph there. And then on the right hand is where we are today. Now, if I were to ask all of you, and I've asked other people, how do you feel about taxes? The general answer is, I hate them, they're awful, they're high, et cetera, et cetera. But when you take a step back and you look at it historically, what you'll notice is that we have been and continue to be in a low historical tax rate environment. And in fact, if I overlay the debt, and why these graphs don't necessarily correlate, what is interesting is in the last 10 years, our debt has far exceeded the revenues. Now, I don't know about you, but if I'm running a business or if my personal balance sheet looks like this, I've got a couple choices to make. One, I've either got to reduce my spending, I've got to increase my revenues, or likely a combination of the two. So with that information, does anyone think that taxes will not increase? Or let me put it to you this way. Will taxes still remain low into the future over the long term? Now, why does this matter? Why does this matter for Ryan, Tiffany? Why might this matter for you? Well, for the majority of Americans who do the majority of their savings in 401ks, IRAs, 403bs, where we can take a nice deduction and the amount grows and then all of it is taxed at a future amount, that can put us in a little bit of an uncontrollable factor because we're not just deferring the tax, but we're also deferring the tax calculation. So if you have $1 million accumulated in your IRA, do you really have that value? And the answer is no, you don't. You have whatever the IRS says that you have at the time that you take that distribution. So we're in a unilateral partnership with the government, and they get to decide how much of our money we get to keep. For Ryan and Tiffany, this is very difficult to plan for the future when there's such an unknown number at the end. So now that we're all in a good mood, and maybe you feel like this particular couple, what do you do about it? What are your options? Now, we're all taught to diversify. Don't put all your eggs in one basket, but most of that discussion relates to a risk-reward perspective. Very rarely are we talking about tax diversification. Where do I accumulate cash? Where do I build wealth? Where do I save from a tax benefit perspective? And I'm going to talk to you about that. There's only 3 places. The first, of course, is tax deferred. We've talked a little bit about that. If I make $100,000, I put $10,000 into this bucket. My new taxable income is $90,000. Great, I just had a nice deduction. But 100% of that contribution and its growth is taxed at time of distribution. So you can have too much in that bucket. The next is, of course, taxable. Now, the advantage here is liquidity. These are your stocks, your mutual funds, your CDs, your savings, your money markets, all of which have its growth taxed. Now, some of it, of course, on long-term capital gains, which is at a lower rate, some at short-term. But all the growth is diluted from tax continually. So you can have too much in that bucket as well. The last bucket, unfortunately, is very rarely talked about. It's tax-free. Now, what do we mean by tax-free? Well, in order to qualify to be tax-free, you have one requirement. That is, you have to truly be tax-free, meaning free from federal, free from state, and free from capital gain. Now, in working with hundreds and hundreds of clients of all different income, all different net worths, in fact, if I were to poll all of you, what I'll likely find is that 80% of your net worth, at whatever level it is likely concentrated in the first 2 buckets. very little to nothing will be allocated into the tax-free bucket. So very simply, we can put people in more financial control by just reallocating assets from one bucket or another into the tax-free bucket. Or for Ryan and Tiffany, for those of us that are in the accumulation phase, reallocating contributions that are going to those buckets into the tax-free bucket. So what are my tax-free options? What do those look like? Well, there's only two. And the first is a Roth IRA. Now, many of you, I'm sure, are familiar with this. Some of you may be implementing this. You may have an individual one. You may have a Roth 401k option at work. You absolutely need to take advantage of these. These are wonderful, wonderful vehicles. But for most of the clients that we work for, there are limitations that hinder this from being a primary option, one of which is the contributions. There's a contribution limit. That's $6,000 or $7,000 if you're over age 50. So for many of our clients, this doesn't necessarily move the needle of getting into that tax-free bucket, putting enough in that tax-free bucket. The other is you can actually earn too much income. For individuals, it's $137,000. For married, it's $203,000. So for Ryan and Tiffany and for maybe others, they can't consistently contribute to this bucket. So what's the other option? What if there was an option that had all of the benefits without any of the limitations? What would that look like? And we're going to spend the balance of our time dialed in and focused in on this particular option. And the reason is because it's likely the least understood tax-free asset that is available to most people. And that's cash value life insurance. And many of you may be thinking, are you serious? Really? Cash value life insurance? Yes, but that's because unlike the traditional view of life insurance where we're focused on the death benefit, in this particular aspect, the death benefit is completely secondary to how we're utilizing it. Instead, we're focused on the cash value. We're focused on the aspects that the cash value has as it relates to the internal IRS code. All the cash value grows tax deferred. If you take it out properly, it's tax free. The death benefit goes to our heirs tax free. In fact, many policies enable you to accelerate the death benefit to cover long-term care costs. And that also is tax free. Any cash value life insurance has two components to it. It has a death benefit and has cash value. Under the traditional approach, when we view it where the death benefit is primary, we're trying to get the most death benefit and a little cash value is coming along for the ride. Under this particular way that we utilize it, it's flipped. Instead, we're looking to minimize the cash value and minimize the death benefit and maximize the cash value. And we do that because we're trying to create a tax advantage asset. We want to utilize this properly to supplement income on a tax-free basis. And whatever we don't use is going to pass to our heirs tax-free. There's no contribution restrictions. And there's no 59.5 penalty to access money. So for a lot of individuals like Ryan and Tiffany, where liquidity is a concern, this is another area where we can warehouse cash. Now further, and might be interesting, is there's a minimum and a maximum to any given death benefit based on your age, your health, your gender. And the entire industry focuses on the minimum. You've probably focused on the minimum. Insurance companies are trying to get your business, trying to buy for your business, and so they want to see what's the lowest premium I can get away with for that particular death benefit based on the risk. But the insurance companies have very little control over the maximum amount for any given death benefit. It's actually the IRS, the government, who controls now. Now hit pause for a second. Why would the government have any concern with how much you pay for life insurance? And that's because when it's structured properly and implemented correctly, it can have significant tax advantages. So under the traditional view, we view insurance as an expense, and it should be viewed that way. It's a protection item. So I want to buy the most death benefit for the least amount of money. But when we flip that lens, and instead we view this as an asset, it now changes. It changes to I want to secure the least amount of death benefit I can get away with for the most amount of premium I can contribute. We're actually developing an alternative asset class, which for some of you may be a very, very new way to look at it. And as we progress through this presentation, I'm going to reference this for simplicity's sake, as a life insurance retirement plan, or a LIRP. Now, Ryan and Tiffany, and I'm sure much like you all, have done a great job diversifying as they've accumulated wealth and continue to accumulate wealth. They have their equities, they have their fixed, they have their bonds, they've got their cash. We are talking about some real estate. Now we've inserted the LIRP. We've inserted this insurance to complement and coordinate with everything else that they're doing. We've utilized the plan that has a guaranteed interest rate plus dividends, and dividends that have been credited every single solitary year for nearly 100 years, and in some cases over 100 years. They've never not paid a dividend. They've never not paid a positive return. So it's a very, very predictable growth asset. And why we're so concerned with this, and why we believe that this is such an important asset class to insert into your overall portfolio, is because outside of the tax benefits, it also can be a wonderful volatility buffer to hedge against market risk. And so I want to spend just a moment talking about that, because I believe that in our current climate and environment, I'd be remiss if we didn't touch on it. So what is volatility risk? What does that look like? So I pulled a chart just recently here, Dow Jones and S&P 500 over the last 30 years. And I know we've all heard from experts talking about that over the long haul, a well-balanced portfolio will increase in value. And historically, that is correct. But that doesn't mean that there aren't dips and recessions along the way. And while Ryan and Tiffany are in their accumulation years, this doesn't matter that much. I mean, it doesn't leave a very warm, fuzzy feeling for them, but it doesn't matter that much, because they're going to ride the highs, they're going to ride the lows, and they're going to experience an average rate of return. But when Ryan and Tiffany enter the distribution years, for those of you that are in the distribution years, or when you enter the distribution years, and if you're relying on an asset and pulling from that asset when the market is down 10, 20, 30%, that can have a significant impact. And I can tell you, working with clients, for those of them that had most of their assets or a significant portion of it in a market equity type exposure, relying on that asset to live off of, their situation would be significantly different. So what we're really talking about is sequence of returns. The entire industry loves to focus on average rates of return. It's simple, it's easy. And during the accumulation years, average rates of returns are fine. But during the distribution years, the actual return matters. The sequence of return matters. And I'm going to illustrate that point by just going over a simple example. So we have Investor Blue, and they have $100,000 in an account, and he's going to withdraw $5,000 a year for 15 years. He's experiencing a variety of rates of return throughout that period of time, and it averages 4%. And at the end of the 15-year period is $105,000 left over. Now, what if we took that same example, same starting amount, same withdrawal rate, same average rate of return, but we just modify the sequence? Instead of it going from 8% down to -5, as you see there, we reverse it. We go from -5 to 8%. That little change can have significant impact. In fact, Investor Blue has $70,000 more than Investor Green, simply because the sequence of return was different. Now, why do we make such a point of this? Why are we concerned with this? Well, the point that we're trying to come across is the need to implement a volatility buffer. What we have found is that if you can have another productive account, an account that has no market risk, and pull from that account when the market is down, you can significantly not only impact the wealth, but the duration of that wealth. In fact, you can actually pull more from your overall portfolio. So implementing a volatility buffer is critical for Ryan and Tiffany, and likely for others during their accumulation, because we're accumulating with the distribution in mind. What does a volatility buffer look like? Well, one, it has to be a productive account, it has to grow in value. It can't have any market risk, because of course that's what we're mitigating against. It's got to be easily accessible. It has to be liquid. You can't be penalized or have restrictions on accessing the funds. And I'd also suggests that we have to limit the opportunity cost. Now, when we look at the LRP as a volatility buffer, what do we see? Well, one, it's a productive account. It grows in value. It doesn't have any market risk. It is liquid. In fact, it's accessible pre-59.5 and certainly accessible after 59.5. But it also has a very, very unique aspect to it in the plans that we utilize. In fact, if Ryan and Tiffany were to pull money out of this, let's say it's 20,000, 30,000, it doesn't matter. If they're pulling money out to live off of in a down market cycle, the market goes back up and they repay this account. The insurance company will credit them the same interest and dividends that they would have otherwise received had they left the money in there the entire time. Can you imagine a bank account, a brokerage account, a money market account doing that? Of course not. They're not going to credit you the same interest if you pull money out of it. But believe it or not, it exists when structured properly and deployed properly in these particular vehicles. So let's go back to our client. Let's go back to the Bell family. We've gone through the situation. We've shown them how they can be in more financial control. We've done a lot of fact finding. We've done a lot of flight simulation. And now we're ready to implement a plan. Now, as a household income, they make about $275,000, and that may be more than some of you are making on the phone. It may be less than some of you are making on the phone. But one thing is consistent. Based on everything that we know about where they are, what we've gone through, where are they over-concentrating their wealth accumulation? They're doing it in the 401k. And in fact, they're contributing $39,000 a year into this. And I'm not so much worried about how much they have in there now. What concerns me is how much that will grow to. And because we believe tax rates are going to increase, the tax liability that is going to create for them in the future is concerning and concerning to them. Now, they also have a company match. That they've got some very lucrative company matches. So the last thing that we want to do is reallocate dollars that, right? That's free money. But we might be able to reallocate the additional contributions and take a look at that. The other aspect, and this is pretty important for young families, and I'd argue it's pretty important for anybody, is the last thing we want to do is add another line item to their savings plan, add another expense, overextend them even more, because we don't have to. We can focus instead on where they're currently contributing and reallocate those to have a greater return and additional leverage. So in their particular case, we're going to look at reallocating the amount over and above the company match, which in this case is $28,900, and we're going to do it in some other bucket, some other vehicle. Now this might be where you say, oh, hit the pause button, Craig. You cannot contribute $28,900 into that account. And you're absolutely correct, I can't. Why? Because that money was going in pre-tax, and now we're taking that additional distribution and have to pay tax on it. So it'll be a little lesser amount. So what are their reallocation options? Well, one, let's look at a Roth IRA. Immediately, they make too much money to contribute to a Roth and certainly consistently contribute to a Roth, and they don't have a Roth 401k option. And from a liquidity perspective and some other aspects, it really isn't viable. Now, there may be some opportunities here into the future to do what's called a Roth conversion or a backdoor Roth, and that's something we'll likely help them with, but right now, it's just not an option. And so instead, we're going to look at reallocating into the LRP strategy. We're going to reallocate the net distribution of the 401ks. We're also going to add what they're contributing to their college savings plan. And we're going to do that because the life insurance can actually mirror and mimic the 529 plan, only with additional flexibility. So while that amount is nominal in comparison, it's still additive. And with that result, we're going to reallocate $2,000 a month for 10 years. And when we do that, that's $240,000 worth of contributions over that 10-year period. $600,000 of death benefit comes along for the ride. And while that's secondary, it's certainly still important. And I would argue very important, should heaven forbid anything happen to Ryan and Tiffany prematurely. That death benefit can also be accelerated to cover long-term care costs in the form of a chronic illness benefit, tax-free. But why we're really doing it is so that we can predictably generate $810,000 worth of tax-free income through retirement And since everybody dies, and in this model we kill Ryan and Tiffany off at age 90, $239,000 is going to pass tax-free to likely Samantha and Wilson. So by simply reallocating a portion of existing contributions, a portion of existing assets, we are able to generate over $1 million worth of tax-free wealth to the family. Now, I don't know what the tax equivalent would be of this, but I can tell you it's a heck of a lot more than $1 million. Now, this might be where you say, okay, Craig, I like this. This is a great idea. Ryan and Tiffany said the same thing, but how does this compare? What would it look like if I were to continue to put this into a 401k? What would it look like if I put this into an IRA, a magical IRA bucket? So let's look at that. Let's say that we could put that same $24,000 into, again, let's say an IRA. If we could actually put $24,000 in an IRA, we do the same contribution, we take the same distribution, the same income, and we do it over the same timeline. We're going to put in a 6% pre-retirement growth rate year over year. We're going to rebalance that to a 4% post-retirement growth rate, and that's primarily because we can all agree that in retirement, when you take distribution, we're more in a preservation mode than we are in a growth mode, and we're going to tax it all at a 35% combined tax rate, which personally I believe is very conservative, considering that many experts believe that tax rates are likely to double in the future. Under the alert, we take $810,000 of income out. We took $810,000. We received $810,000. We die at age 90. Ryan and Tiffany, the kids, received $239,000 tax-free. Now, if we put that into a tax-deferred comparison, 100% of those proceeds have to be taxable. And so from their perspective, they'd have to pull out 1.2 or over $1.2 million just to net the same 810. They die at same age 90, there's 121,000 left over, and that's before tax. Now, I've also stress tested this multiple different ways. And if Ryan and Tiffany experience 2 down markets in the first 10 years, they'll run out of money at age 87 based on the variety of assumptions that we've used. So not only have we insulated and protected them against increasing tax rate risk, we've also insulated them from market volatility risk. So as we look at what we did for Ryan and Tiffany, as we look at the plan that we set out, the objectives, the goals to put them in more financial control, eliminate various uncertainty, did we do that? Well, with taxes, yes, we did. The cash value, the death benefit, the long-term care are all tax-free. What about market volatility? Well, to some extent, we did. There's no market exposure. And during the accumulation years and during the distribution years, not only can this be pulled out for income supplement, but also can be leveraged so that when there is a down market, they can pull from this account and mitigate the loss in the equity exposed accounts. What about healthcare costs? Well, we help with that as well. The ability to accelerate the death benefit to cover long-term care needs can significantly impact and preserve the wealth moving forward. Now, we did not touch on litigation. And Ryan and Tiffany reside in Kansas. It's actually where I'm speaking to you from today. And Kansas is one of the more favorable states as it relates to asset protection and life insurance. But many states are similar. So while we're creating and building this tax-advantaged asset, we're also insulating it from any litigation that may or may not occur into the future. This is usually where I get some frequently asked questions. One of which is, how long has this strategy been around? And I can tell you that it's been around a long, long time. In fact, if you've read the book, What Would the Rockefellers Do? This is indicated in there as a major piece of how they've built generational wealth and still do to this day. Walt Disney actually used his cash value to help start Disney World. More current, Jim Harbaugh, the coach of Michigan, if you Google his compensation, this strategy is a significant portion of that. Your major firms, this is a major part of the executive compensation. In fact, banks are one of the largest purchasers of life insurance around for their executive staff. So it's been utilized by many for the similar reasons that we're utilizing it for Ryan and Tiffany. Can it be overturned? This is a great question. In fact, it's been challenged and modified about 3 times. I believe the last time was in the 80s. And each time, the old rule has been grandfathered. The old policies have been grandfathered. In other words, if you have an old policy, those go and are subject to the old rules. The new rules, subject to the new policies. Why haven't I heard about this before? Well, you may and you may have not, based on some circumstances. But keep in mind that the majority of the industry is focused on the accumulation. The majority of your money management institutions are focused on the accumulation. They view insurance as protection, as an expense. They're focused on trying to get you the best average rate of return to accumulate your assets, and for the most part, they do a great job. But this is just outside their box and outside their expertise. Can I use my current advisor? Well, you certainly can. We actually work, in many cases, much of our business, about 60% of it in some cases, comes in from other financial advisors because they utilize us as subject matter experts. So these plans need to be implemented correctly. They need to be serviced correctly. You need to work with somebody where their focus are implementing and servicing these plans. What if I'm not insurable? This is a great question. And it's the right question to ask when you look at insurance, because insurance needs to be underwritten, and underwritten based on age and health, etc. Under the traditional view of protection, this comes into play. But when you're building an asset, you're focused on the cash. The owner controls the cash, and the owner can be different from the insured, so long as there's an insurable interest. So your spouse, your kids, your nieces, your nephews, a business partner can all be utilized. So we very rarely, when we're building this as an asset, do we run into an insurability issue. You can get a lot of additional questions, obviously talking to your advisor and consulting with us, but a lot of questions can be answered in these 2 books written by David McKnight. David McKnight is a friend, he's a colleague. We have him speak all over the country. Certainly with the quarantining here, that's become a little bit more difficult, but these are great resources. And the Power of Zero is focused on mitigating taxes. How do you get into the 0% tax bracket? The Volatility Buffer is, of course, focused on implementing a volatility shield, a volatility buffer. Each one is very, very good. I would recommend that you talk to the advisor who invited you to see if you get a copy of that book. If for some reason you're with us here today and didn't have an advisor that invited you, reach out to me, and I'm happy to arrange to get you one. So I'm sure that there are a lot of thoughts, reactions, maybe additional questions that you're thinking about. And so some key takeaways that I would leave you with. One is that future taxes are unknown and can and will erode value. Uncertainty is a reality that we must plan for, but actually can be controlled. Diversification is an absolute must, not just from a risk and return perspective, but also from a tax perspective. Implement a volatility buffer. Put yourself in control, because when you're in the distribution phase, when there is a down market, and there will be a down market, you're in a position to protect against that. Grow your tax deferred bucket, because if taxes do increase, as we anticipate and expect, you're protected and prepared for that. Some action steps. Talk to the advisor that invited you. Learn more about this particular strategy. Read, research, plan, so that the when and what if doesn't financially matter. Because what would the cost of doing nothing be? I would suggest that it could be very, very expensive. So I want to thank you for your time. I hope that you stay safe and your family stays healthy. I hope that some of this information, while we went through it at a fairly high level, resonated. It was new information, made you think differently. I know that there are some questions that have been pushed out on the chat. We will get answers to those questions directly to you. We can email you and call you directly to do that. But I want to thank you for spending some time. I hope that you continue to reflect and hopefully do some things that you care about, are able to slow down as we all work through this challenge in the coming weeks. So with that, thank you for your time and all the best, and I hope to talk to you all very, very soon. Thank you.